Irani joins us now. Let's connect with him. Dinshaw, good morning. Thank you for joining us. Dinshaw, I mean, what an extraordinary market. From 4th of July, that extraordinary bout of volatility, the markets have managed to climb the wall of worry. All the scary price action of 4th of June now is history.
Thank you, Nikhil, for having me on your show, and a very good morning to you, your team, and your viewers. By the way, you started off as 4th of July, so I was wondering what you're talking. But anyway, the fact is that, that was a jitter. But I think once the cabinet was announced, that's when some frayed nerves were soothed up as such, because it was obvious that this is the old uh, government continuing into the new one, because none of the key cabinets were given out. All the key ones were kept with the ruling party. So it was obvious that they control the coalition as such. And actually, it wasn't a messy coalition at all. It was just two people that were to be managed as such, which were the fair part. But the fact is that now, Nikunj, onwards, from here onwards, we don't see much of positives or negative triggers in the market. So maybe it'll be in a fairly tight band, somewhere near the top that you're seeing on a daily basis. So it may just be in a tight band till the budget comes through. And from there on, one has to evaluate again. Having said that, there are certain pockets which are definitely overpriced. For instance, the mid-cap space. We think that's heavily overpriced as such. I mean, as in the valuations that are fairly frothy, given the fact there's only 150 companies in which the fresh flows are invested on a regular basis. So there, I think one has to be cautious. Otherwise, everything else looks on track.
Right. That's quite interesting, Dinshaw. Hi, morning firstly. So what is it that you've done in your mutual fund folios? I mean, have you eased off from mid and small caps?
So, Asha, good evening. Actually, we've been, if you look at the mix of our portfolio, obviously large caps is a big chunk. In my flexi cap, I'm talking about. Then the small caps take up a bigger chunk, and the mid caps are fairly smaller as compared to both these chunks. But one thing that we loaded up on, and I was hoping that Nikhil would start with that, was obviously our favorite, which is the financial sector. So we've been in fact, so bullish on that sector that we brought out actually a first sector dedicated fund from the house of Helios as such, which closed on 14th, which was financial services fund. And I think the timing could have been better, I suppose. So anyway, so we're loading up on that particular portion as such in the large. And fortunately, most of the stock there are in the large cap space.
Okay. If one looks at financial sector, some would argue is more like a crowded trade. Just like you like it, everybody likes it. So is there scope for surprise when everybody is of the view that financial is the go-to space?
So actually, Nikunj, in this market, you're looking at some kind of valuation comfort. You're looking at some kind of growth, and obviously, this sector has been fairly consistent. I mean, if you look at the 20 years prior to COVID, the sector was an out and out total outperformer, right, as compared to any other index that you could pick out, the financial services and bank index I'm talking. But during the COVID period, the see, I mean, obviously there was a massive underperformance by this particular sector per se, but actually there were only two banks which were dragging the whole performance down. You know the names, right? HDFC Bank and Kotak probably were the two guys who had a 40% weight in the index. So if you take these 2 hours, I'm sure the index would have done fairly well because I saw the other component, the big components, ICICI Bank did well, SBI did fairly well as compared to the markets. So it was only these two which were dragging it down. So there was a belief that these guys, the sector per se hasn't done too well. But actually, if you go to see in the future, if your economy is going to grow, then obviously this sector, which is the backbone of any given economy, has to grow better than the economy as such. So it's obvious that there's this. And secondly, the comfort, as I was saying about the valuation bit, look at the pre-COVID valuations and look at the valuations today. They're still at a discount to the pre-COVID valuations. So it's obvious that this is a go-to sector for any smart money which is coming into the country. By the way, the FIIs, they've been regular sellers, right? And bulk of the selling has been in the sector. So once they come back into the markets, you'll see the sector being their favorite again.
Absolutely. That's the first port of call, and clearly that's where the valuation comfort is. But other than large private banks, Dinshaw, are you bullish on the entire banking space? What about PSBs, for instance, and ex-SBI, the smaller ones?
So Asha, it's not only the banks we're bullish on the whole sector per se. I mean, banks are just one portion of that sector. There's a 12 or 13 other subsectors within financial services, which are very exciting. And frankly, I mean, the wealth managers, the exchanges, the brokers, the depositories, all these participants are lying there. I mean, to be picked up, and they've done well. Actually, they've done well in the past, and we don't see them doing any worse in the future. Also, we expect them to participate in this whole rally, because if you're talking about per capita is going up, this is the wealth. The gatekeepers to that wealth have to participate too in that, right? So that is where we are bullish on. Apart from the private sector banks that we've always been bullish on, we've been very selective in our approach to public sector banks. We got only two in the portfolio, which is fairly public. You can see it in our declared portfolio as such. And I don't think we'll be adding to that in a rush anyways.
Dinshaw, till how long the party will continue for the so-called policy stocks? I mean, they are expensive now. While earnings are strong, but they are expensive. That's the bottom line.
Actually, yeah, Nikunj, we've been also quite cognizant of this fact, and some of the stocks that we've been moving out of are mainly those names. Like, for instance, some of the stocks in defense, we've not been too comfortable with the valuations now. They look very stretched to us. So we've been chopping some names there as such. Railways, we've always been away from. I don't think the valuations that are there today are justifying any investments. I mean, even looking at the future growth there. But there are certain pockets which are still fairly, I would say, reasonably priced, not as compared to history, but reasonably priced as compared to the peer group. For instance, the oil and gas sector, which looks fairly reasonable. Even in the power space, the utilities and obviously the transmission companies that I'm talking about, they are looking pretty decent, given that if India was to become the sourcing base for the world, power is one thing which is going to be an intrinsic part of that, right? And the fact is that we have paucity of generators as such, so power generators, that is. So obviously this space looks fairly okay as of now. Again, valuations are stretched, but looks okay. So there are only pockets in which you can work on. Apart from that, I agree with you that most of the space looks fairly stretched.
Manager, when you say things are looking stretched, what's stopping you from raising cash? What's stopping you from selling those positions completely?
So no, basically, as I said, that oil and gas, we not at all. I mean, we were quite comfortable with that space as such, and I believe that the promoter of that particular space has changed. His mindset has changed towards rather than using that as a political tool, he's using it more as a wealth creator for the government as such. So that's what we like about that space. In the generation space, as I said, that basically there is going to be, and obviously we're talking about the number one player in the country as such, it's an NTPC actually, and that itself. Looking at the fact that he's also going to go green and stuff like that looks fairly exciting today. Though the valuations, I mean, stretch as in, if you look at the history, they've always been at a massive discount to the private players. So I think they're coming at par with the private players. And that is why that comfort, that since we don't now distinguish between them and the private players as such, and the fact that the growth is much exciting out here, is why we're holding on to that. So that's why we are very comfortable in this place.
Foreigners are coming back, and if one assumes that look better late than never, and foreigners are back, then we could look at absolutely no selling in the market. DIs don't want to sell, FIs who were sellers, they don't want to sell. Retail obviously is chasing stocks. What happens to the market then? I mean, there are no sellers. So
hopefully you'll see a lot of private placements happening. You'll see a lot of, and they already are, right? I mean, you've seen that in the past. Yesterday alone was some 20,000 crores of placements which are undertaken as such. So it's obvious that there's the promoters or say the PE guys are looking at cashing out. So they will give the enough supply to the market to take care of this. And actually, you are right. If everybody's a buyer, obviously the markets are gonna go to the roof. But ultimately, there'll be some smart guy who will come and take a call on the valuations rather than purely on this. So I'm sure the markets have its own checks and balances, Nikunj, and there'll be a time when someone will take a call on this and probably fire the first shot.
Absolutely. So other than banks, Dinshaw, where is it that there's still valuation comfort? Or would you say it's only banks and nothing else?
No, Aisha. There is enough and more. Actually, one of the other spaces that we are fairly bullish on is tourism, because I think that space is totally paucity of good rooms and stuff like that. So that's why we are fairly comfortable there. There again, if you look at look at overall the markets. Okay, I mean, if you were to look at 20-year averages for our large cap indices, I think the P's were some 15 and a half times forward earnings or something. Today, there are almost 20 plus forward earnings. But the fact is that you're re-rating India, right? I mean, you're re-rating India basis the fact that we're going to grow better than what we were doing in the past. Our balance sheets are much more cleaner than what they were in the past. Our obviously return ratios have gone up far, I mean, rather doubled from what they were in the past. So we've got re-rated. Now to maintain that re-rating, you got to continue this on this path, right? And I don't see any deviation from this path. That's why most of the sectors, if you look at history, you'll say, oh God, these guys are too expensive to go in now. I don't think that's going to work, right? Can't be driving a car looking at the rearview. You've got to look at the future and I mean in the front and do the thing. So that's what we're taking a call out here. Even the tourism sector, if you look at history, they look very expensive. But if you look at what they're proposing to do, what India is going to propose to do, obviously there's a re-rating happening everywhere. So that's another sector that we are comfortable with. We are fairly comfortable with the QSR space. I mean, in the consumption such in the QSR space, I think that's one area that's going to pick up. Obviously, the platform companies, again, they are looking very exciting. In fact, in the past few weeks, we've been adding to one particular platform company, a new name actually in our portfolio, which is more of to do with the pharma as such. And I think that is the way India has to go. So I'll leave it here.
Great to have you on the show as always, Dinshaw. Thank you so much for taking the time out.
Pleasure all mine, and thank you.
Okay.
If you like this video, then like, share and subscribe to ET Now.